when we're done with this, can
There we go. Looks good on film here. Hey Natalie, how you doing?
Good. How are you?
I'm good. Can you hear me well? See me well? I mean,
You're blurry.
blurry to be
I can
honest.
hear you, yeah, but you're really blurry.
Blurry. All right, so we gotta kind of fix that. If I just do this, just gotta refocus it. That's all.
Yeah.
Here.
Is that better?
No, it's because I keep going in and out. There we go. There we go. That looks better. Good now.
Yeah, it looks good now.
All right, it might go back and forth while I let some people in, but that's okay. How was your week so far?
It's good.
Yeah, I saw you getting some sits with your sis.
Yeah, I mean they were tough clients, but we gotta have them, right?
Yeah, I mean I would rather have somebody that puts up a little bit of a fight, to be honest with you, than somebody who kind of just lays down and is an easy sit. You know,
Yeah.
you don't
Good
really
to see that both ends, like not just the easy, but also it's good to get the hard ones out of the way.
Yeah, 100%.
So you know.
100%. See if I can admit Lita without moving the camera. There we go. I think that's the key, is me to go quick down through. Boom. Bam. There we go. We got kind of a weird setup. We have an agent doing a presentation in a normal room, so we had to kind of switch gears. It's okay. It'll work. The whiteboard's not as big, but you will still get the gist of it. We'll be okay. I think we're just waiting for Roy, Aubrey, and who else? Bobby. And anybody else? Okay.
Roy's Casey's new guy, right?
Yes.
Who's Bobby?
Same.
Oh.
Yeah, I know where they're at. It's 1 o'clock on a dot. We'll give everybody a couple minutes. I get technical difficulties. It happens.
Hey Roy, you're gonna sit down with us with the training?
We're on blast.
Hey Roy, how's it going, man?
Hey, what's up? What's up? Hey, good job on that sale yesterday, guys. You and Lita.
Thank you. Yeah, it was a contingent beneficiary, guys. Like, they're the easiest sits you can get by far.
Oh, okay. Okay.
They already know what the program is. You know, they understand why we're there. You know, we're there to go over life insurance. You know, how much easier of a sit could it be, right? And that one was even easier because I sold the guy on Friday, and that was his daughter who lives in the same house, and I sold her on Tuesday.
Okay.
So she has kids, she needs coverage, so you know, might as well help them out with it. There's Aubrey right here. Got it right there. All right. Well, just a blank screen now, but I'm glad everybody's camera's on. That's good. All
Yeah,
right.
Bobby's locking down his first sale right now.
Yeah, I heard. I was just way over there in the other room with Casey, so I saw that. But so yesterday, Tommy went over with you guys proactively beating the rebuttals, correct? Parts in the script where you can use to effectively beat things that they're going to say down the road, correct? So, and then Monday, Josh went over the needs analysis and term versus whole, right? So the next step in everything there is explaining the list of concerns, right? And breaking down what the needs analysis spits out to them, okay? So what I'm gonna start with is the list of concerns, okay? So this, to be honest with you, this is one of the more critical parts in the presentation, right? Typically, you're gonna do the list of concerns before you do the needs analysis, right? And then after the needs analysis, when it spits out all the information about they need this benefit, and this benefit, right on the e-app, you can explain each one of those benefits, right? That's what we're gonna get into detail today, the verbiage for that, okay? So now you guys know the list of concerns and why they exist, right? So with American Income, we represent about 30 to 40,000 different groups and unions, okay? And these groups and unions, they have presidents that sit on the board, right? Their union president approves our programs for its members, meaning he didn't just flip through a phone book and pick our company, right? They sought us out, they liked our programs. Now, each one of these unions, most of them have a person on the labor advisory board, okay? Our labor advisory board is made up of a bunch of union presidents, right? And it's actually right here. I don't know if you guys can really see it. Let's see if we'll focus on it. These are all the union presidents, right, on the labor advisory board,
Oh.
right? So there's one for almost every single union. You know, James Hoffa, he is still one of Hoffa is still on the board for the International Brotherhood of Teamsters, right? You can even see if you guys are NFL fans, DeMaurice Smith, the NFL Players Association, is part of our labor advisory board, right? And it's made up of, you know, the top people, Terry Sullivan, Denise Boyer. Denise works in our area, right? She's one of the main representatives on that labor advisory board. Of course, Roger Smith, and then Mr. Steve Greer as well, right? So why this is important is because these people get together and they came up with a list of concerns that the union members had for our company. So stuff that they wanted us to take, benefits that they wanted us to take care of for them, right? Now, the concerns are, I'm gonna run through them with you. The first concern is permanent and portable benefits. Making sure that when they leave work or they quit or they get fired, that they still have permanent benefits set up that are union negotiated. So what that means is every one of our programs is permanent to that member, not their union, right? That's why when the policy comes out, it comes out through their bank account, not through their union or not through their paycheck. Does that make sense? So our benefits, every single one of them is permanent to that person or that family, not that union. So they could leave work tomorrow and still keep our benefits. Doesn't matter, right? That's the great part about it. Now, the second concern, right, is making sure that the final expenses were taken care of. And this is a big problem and concern for our members because some of our union members are passing away and they were leaving a big burden on their family for final expenses, right? Now, the next, concern that they had for as well, and I'm going to dive into these next four pretty extensively here in a minute, but the next concern is making sure that their income was protected. So that, if God forbid Joe didn't come home from work tomorrow, at least Joe's paycheck came into the house every single month for the next 24 months. Give her 2 years, right? Give her 3 years of her income, right? And then mortgage protection as well, or rent protection, right? Most people's biggest asset that they own is a home. But unfortunately, until that home is paid off from the bank, they don't own it. The bank owns it, right? So they want to protect that asset that they have. And then the last one would be either it's kind of three jumbled up. It would be like either the kid's education, it would be debt protection, or it would be like kind of a legacy that you wanted to leave behind for your family. And that would be more or less making sure that if you didn't come home, that your kids had education funds set up for them, or if they didn't want to go to school, they could have money to open up a business or go to trade school or something like that, right? It's more or less future planning, right? And the debt protection would be make sure that if you did die prematurely, that all your debt didn't go to your family, right? So that was the first five. And then the sixth one is benefits that would be affordable and able to qualify for. Right? Because these benefits are all great and everything, but if our members can't afford it, or if they can't even qualify for it, that's a different thing. Like, why would we even be showing them this? Right? Now, the qualifying part is a little bit different, right? But you'll see that a lot of our programs are affordable for our members, right? It's not out of the ordinary for what some of our members have paid $200, $300 a month. And some of them are getting paid $40, $50 an hour, right? So the best part about the needs analysis is as you've seen, it does break it down to where about 5.5% of their income, right? Now, when we go over these lists of concerns with our members, the one thing, like, now every team does this a little bit differently, but it's all the same exact thing, right? You might do it in a different spot, but the way to explain, like I know Gio's and Vince's team uses a pie chart, right? We do the same thing. All right, can you guys see that on there? No, the light's all banged up. Maybe just try this. If I hit it, no.
Should I open the
That's
windows?
worse. Yeah, see if you can open the windows real quick. Or I just need a better marker, maybe.
There you go.
No, you can't see it, huh?
I mean, that last marker was better.
Yeah, you could see it a little bit.
Okay. So maybe if I just draw it nice and slow.
Try turning the light off. I don't know.
Yeah, it was like once you turned the light on, it got worse.
Light on or off?
Oh, it's the curtain. I mean the.
Yeah, there's like a glare.
Yeah, the glare is there. Okay. So close those real quick. No, there's so much glare. Let's see if I can bring this in closer. There we go. Maybe that'll help.
Yeah, that's all right.
Okay.
Is that good?
Well, they can actually see the circle now because I just brought it in closer.
Can you see the glare?
Does that look okay? Okay. All right. So the pie chart, or the list of concerns, is what I typically call this here. This is kind of where you're going to break down the coverage for the members, right? This is a good spot to, number one, show them the needs in like a visual representation of it. And number two, it's going to, you're able to use their coverage that they already have and show them where it's going to go. All right. So this should be something that you typically individualize with every family. If that makes sense. Right. So the first part of the pie chart over here, I'm just going to make it F. Oh, this marker's the worst. I swear I had a good marker. I don't have it.
Yeah, you did. There's one in the back room.
You see that? It says FE, final expense. FE stands for final expense. Okay. So the way I like to break this down with our members is I like to ask them questions here. Like, you should be asking a lot of questions in this section, because these questions that you ask them are going to be, number one, geared toward finding out what their needs are. And number two, we're going to be making them kind of sell themselves on why they need it. Right? That's what this whole thing is doing here. It's getting them to sell themselves on the benefits. Right? Now, for final expenses, I just usually straight up ask them, guys, do you know how much a funeral costs nowadays? Have you ever had to deal with a funeral? Do you know how much one costs? And most people were like, well, I don't know, probably like 10 to 15,000. Most people are going to be right along those lines. Most people are going to be telling you like, yeah, 10 to 15, right? You might have some people be like, it's 2,000, 3,000. Like, maybe if that's what you want done. Yeah. But nationwide average is 10 to 15, right? You might have some people tell you it's 50,000. At that point, I don't want you to like laugh at them, right? But what I want you to do is kind of make sure that they know, like, yeah, it's not 50,000 now, but down the road, yeah, you're right. It's going to be at that point. All right. Now, what I usually do with final expenses here is I visually show them. Oh, why is it still doing this? Like, come on. Is it just drying out on me?
Do you want me to get a better one?
Yeah, if you could find one. I think it's just drying out. If I keep it out, is what happens. right? So I usually write 10 to 15K there, right up top there. So that they see that's how much it's going to cost for final expenses, right? Now, what I usually do as well is I project backwards and then forwards, right? So, just like your milk, your eggs, your bread, and your gas, right? Every 20 years, prices are doubling, right? So if we go back 20 years, the cost of a funeral, you're probably looking at anywhere from 5 to 10,000. 20 years down the road, we're looking at almost double that, right? Same with 20 years after this. 20 years after this, we're probably looking at 20 to 30,000 for that same funeral. Right? And most of our members are around the same age bracket we are. And I'll ask them now, do you guys plan on dying in the next 20 years? No? How about the next 40? Probably not either, right? So 40 years down the road, you could project it out more. We're probably looking at anywhere from 40 to 60K. So anybody in our age bracket, guys, that's the minimum that they should have. Minimum in whole life they should have right there. Because that's going to take care of now. It's going to take care of 20, 40, 50, 60 years down the road. It's going to make sure they have more than they need to take care of anything that they have going on. Because it's not just funeral, it's final expenses too. We got to remember that part. Because the price of a funeral just doesn't stop there. They got to pay money to get things cleaned up at the house. They got to pay money at the wake. There's a lot of different spots where money is associated with a funeral. It's not just that funeral proceeding, right? So final expenses and everything included in it, anybody in our age bracket, we're looking at 40 to 60. But I want you to kind of customize this to your demographic who you're looking at here. If they're in their 50s, project out 20 years. 40s, project out 30, 40 years, right? Our age bracket, project out more. Does that make sense? So final expenses, a big, huge problem and concern. Now, I want you guys to use problem and concern as much as you can during the presentation. Problem and concern. Major problem and huge concern. Huge problem and major concern. All right? It's not really going to be a problem until we tell them it's a problem. They're not going to see the problem until we make that the problem is there. Aubrey, you got a question?
No, sorry, I was just like clapping my hands like, yeah, huge problem, huge concern.
Okay, good. I just saw the hand up, so it's okay. All right. So final expenses, we want to make sure. Now, the reason why we want to have this coverage in place is typically because no one really has 10 to 15 grand just lying around. Now, if they do, it's probably not for a funeral. They're probably saving it for something like their kids' education, probably saving it for a new house, right? Maybe for a little bit of their retirement. The money that they have saved is definitely not for a funeral. All right, just know that going into it, like they might have money saved. Like you might get a rebuttal, like the guy has, oh, I got 15,000 saved. It's great. Glad you have that, right? But to be honest with you, what did you have that 15,000 saved for? Right? Probably wasn't a funeral, right? So the main thing you want to get across to them here is that the final expenses, that's going to be a burden now, down the road, forever, because that's one guarantee everybody has. They're going to die. All right. So what you typically want to do is project back, and then project out. All right. And get a number for them, because typically when the needs analysis pops up numbers, it's going to pop up what you recommend here. You're going to look smart. You're going to look like you know what you're doing. Right. So if you do this before the needs analysis pops up everything else, they're going to be like, oh man, this guy knew what he's talking about. Or he must have been doing this for a while. All right. Trust factor gets built in there. All right. So anybody have questions on final expenses? How to explain it? It's pretty self-explanatory. All right. Now, when after the needs analysis pops up and then the needs analysis will break down on the e-app where what it would recommend in each situation. It'll play those videos. I don't know if you guys have gone that far through the e-app and watched the videos on it, but it'll bring up a final expense video, right? It'll bring up a income protection video. It'll bring up a mortgage protection video, right? If it shows those needs, it'll bring up those videos, right? Now, typically with the final expenses, we want to make sure that we really hammer home the freedom of choice certificate, right? The freedom of choice certificate is going to take care of the final expenses. That's what it's designed to do, right? It's designed so that when the surviving spouse, the surviving beneficiary goes into the funeral home, that they have a sense of stability about themselves. They kind of know what's going on. They're not getting taken advantage of, right? I don't know if you guys have been through a funeral process or have had to plan a funeral or go to the funeral home, but if you ever walked in there, there's no McDonald's menu board that says cremation's this much, funeral's this much, right? They base it off of what they see. So I can almost promise you, if you walked into the funeral home and usually when I do this, guys, and you should do it every single time in the presentation, is when you're going over the benefits, use their names, make it real, give them situations. Like what we're doing here is painting a picture of what the world's going to look like without Joe or without Mary. That's what we're doing at the end of the day. Because I say this all the time, but what we have for our members is not tangible. They can't, it's not a marker. It's not a vacuum cleaner. They can't physically hold it. The only time they're going to use it is when they die. Right? So you got to make it real. If that makes sense. You got to paint a picture for them. Right? So the way to paint a picture with Joe and Mary is I would say Mary, Joe, I would say first off, Joe, if God forbid you didn't come home from work tomorrow, Joe, who would be taking care of your final expenses? He would probably say Mary, right? Okay, perfect, Mary. So Mary, what you're going to do is you're going to walk into the funeral home and you're going to say, my husband, Joe, he had life insurance. And the funeral director is going to ask him. That's typically the first thing the funeral director asks, to be honest, is if that loved one had life insurance. So he'll say, Mary, did Joe have any life insurance? And she'll say, yes, he did have life insurance, right? The next question he's going to ask is how much life insurance that Joe had, right? And how this person answers that question is going to depict how much they're going to pay for the funeral. Does that make sense? Because if they say, oh, I have 50,000, well, the funeral director is going to be like, okay, well, it looks like the funeral is going to be $49,999 plus tax. You're looking at about 52,000, right? That's because you told him how much you have. Like, it's like going to like a used car lot. If you go to go buy a car and you tell the person how much you're looking to spend, they're going to find a lot of cars on that lot that are at the same price, even if they weren't that same price the day before. I can almost bet that, right? So the reason why is because there's no set prices, because they base that off of whatever they see. So if they see a lot of money, they're going to try to take it all. But our freedom of choice certificate is designed so they don't have to do that. Their certificate itself, all they have to do is put what they negotiate on the back of the certificate and sign it and give it to the funeral director. Funeral director calls our 1-800 number and 2 checks get issued immediately. One goes directly to the funeral director for everything negotiated on the back. Anything left over gets right back to the beneficiary to wrap everything else up. Tax-free, lump sum, 3 to 5 days later, right? So that's how we make the claims on a whole life policy. You can make a claim like that on any policy, right? But that is basically pitching the final expenses to them, making sure that they understand the freedom of choice certificate. Like no other company has this, guys. Seriously, like this is one of the best things. I've seen it work in person. It's the only reason why I'm very passionate about how it works, because I know how it works. Right? When my brother passed away, my sister-in-law had to use this. Right? She didn't have to pay any money up front for his funeral. Right? And it was a huge, huge burden off her back to not have to worry about paperwork. Right? Because she's from a different state. So she had to call family outside from different states and bring them all into Pittsburgh. Right? It was so sudden that we had to get everything done in 3 days. Right? So it really does give you peace of mind and gives you time to get things handled. Right? Now, anybody have any questions on the final expenses? Good there? Okay. Now, typically when the needs analysis pops out the recommendations for final expenses, just know it's going to be whole life insurance, WL. It's typically the only area that's going to recommend whole life insurance on. Okay. Now, the next concern is income protection. Income protection. All right. So that is basically making sure that if Joe did not come home from work tomorrow, that at least Joe's paycheck came into the house for the next 3 to 5 years. All right. So what I usually do is, and keep in mind, I've been doing this for a while, so I can kind of know what it's going to recommend, right? So if he tells me he makes $2,000 a month, right? So he's making about $24,000 a year. I have rounded up to 25. 5 years of his income is what, 125,000? So I would write 125,000 right here. And I would write 5 years, right? So I would show him that 5 years of his income is actually about $125,000. So over the next 5 years, Joe, you're going to bring $125,000 into this house, right? Now, to replace that income, if you did not come home from work tomorrow, you would want to make sure that your wife still had that income, right? You would make sure you want to protect that. So with income protection, this would make sure that for the next 5 years, $2,000 came into the house every single month. It's like you didn't miss a paycheck, right? Because to be honest with you guys, I'm sure you've missed 1 or 2 paychecks before, right? And you figured it out, right? You found a way to get by that. You figured out that speed bump, right? And to be honest with you, you're probably always going to figure it out, right? The only way you're not going to figure it out is if Joe's not here to help you figure it out, or if Mary's not here to help you figure it out. Because you guys are good together, but when someone's not here, that's the issue, right? And if you watch the video that's on EAP, it compares the income stream to the heartbeat of a house, right? So in most cases, both spouses, both husband and wife are working. In most cases. Now you're running into some cases where the wife isn't working or the husband isn't working, right? Those cases, it's a little bit easier to add income protection because it's more of a concern. But if they're both working, right, still they're relying on $4,000, not $2,000. So their bills are at $4,000, not $2,000, right? So it's going to get cut in half if Joe doesn't come home, right? So what I usually say when I'm going over income protection, I would say, Joe, now Joe, you're typically the breadwinner here. You're going to be making a little bit more money than Mary. If something did happen to you, Joe, it would probably be a big burden on Mary to keep up the bills and keep food on the table and things like that, right? So what we want to do is we want to give Mary about 5 years of your income protection. Our company typically recommends anywhere from 3 to 5 years, right? Now, the reason why it's 3 to 5 years is because that gives you a little bit of a buffer, Mary. It lets you go back to school, get your degree. It lets you go get a better job, right? It gives you time. It's never going to bring Joe back, but what it is going to do is going to give you time to move forward. All right. Now, Joe, you're basically the heartbeat of the house, right? Why I say that, Joe, is because your paycheck is like the heartbeat, right? So you have up days, you have down days, up weeks, down weeks. Sometimes you make more money, sometimes you make less money, right? And your heart's always going to keep going up and down and up and down, just like your heartbeat, right? Your paycheck, same thing, right? If you ever looked at, I don't know what that's called, right? EKG maybe, I don't know, but whatever that's called, where the line goes across and goes doo-doo, 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 right? It's always consistent, up, down, up, down, up, down. The only time it's not is when what happens? When you're dead, right? That's the same thing with income protection. If you died, nothing comes into the house anymore, right? If you're still alive, it might go up and down, up and down, up and down. But if you're not here anymore, it's flat, right? Then you basically lose everything that you worked for, right? So having income protection is making sure that, like I said, if you don't come home from work, Joe, tomorrow, and you knew that you could protect the next 3 to 5 years of your income, wouldn't you do that?
Yep.
Right? Now, Bobby's in here. Let's submit him real quick. There we go. Now, with income protection, guys, you're going to run into clients who already have life insurance. They already have coverage, right? And going through term and whole and going through, you know, the actual needs analysis, you'll find out whether or not it's term or whole, right? You'll know. Doing this a bunch of times over and over and over again, you'll know if it's term or whole. What I would recommend, guys, is getting a notebook and writing everything that happened in your SIP. If they have life insurance through another company, write down that company, and your job for homework tonight, research that company. Research what kind of policies they sell. Because most of the companies that we see currently, State Farm, you know, New York Life, Colonial Penn, there's a bunch of them out there. You're going to run into them typically every so often. And if you know what type of policies they sell, you can basically show them what type of life insurance they have, even if they don't know. Now, the best thing to do 100% of the time is tell them to go get their policies, right? So, Joe, you don't know what you have, go get your policy real quick and I'll be able to show you. As the expert, I'll be able to show you exactly what you have and how it works. Right? Last thing we want to do, Joe, is make sure that when we do a needs analysis, that you have all the correct information. We don't want to leave any information out. So it's only really going to make their needs analysis more, I don't even know what the word is, more customized to them, if that makes sense. Right? Because the needs analysis, when you do it on the e-app, it will spit out different numbers depending on what you put in there. It's smart. It knows what it would recommend things. Right? It's why it was designed. It's not like some system you're just like, oh, it's just showing them those numbers. That's just a recommendation. I'll come up with my own. No, it's designed to where it's going to recommend what they should have. And then if they can take care of all of it, great, let's take care of all of it. If not, you could piece it out at that point. Right? But it's really designed as a whole program for that. Right? That's why when I'm doing options with them, I usually don't stray too far away from what the needs analysis recommends. Right? Because if I'm building this needs analysis up and building it up as this is what we use, I might as well use the recommendations from it too, right? You know? So, but the income protection, guys, you always want to make sure that if they have term coverage, like if they already have term coverage, spend it right here. Spend it. All right, what I mean by spend it is if Joe has $100,000 of coverage, right? He already has 100K through, like, let's say State Farm. Guess what I'm going to do with that? I'm going to be like, Joe, you did a great job. You got most of this taken care of with that State Farm policy, right? So I scratch off most of the part, but I leave a little bit empty here. So Joe, you're going to have a little bit of a gap. So during the needs analysis, you guys are going to know it's going to show $25,000 gap, right? You look smarter when it pops up and you told them that's going to happen, right? But what you would really want to get across to them here is protecting either one of their income, making sure that if they don't come home their next 3 to 5 years, their income at least does, their paycheck at least does, right? So does anybody have questions on income protection? No? Okay, great. All right. Now, this would be for concern would be making sure that the mortgage was protected. So MP, or you can use rent protection as well, either one, right? Now, with this part right here, you can just straight up ask them. If you didn't figure out in the rapport if they rent or own their house, then you can ask it right here. They should trust you enough to this point that if you ask them how much they have left on their mortgage, they just tell you like that. Right? I've never really had anybody ever say, nope, I'm not telling you how much I owe left on my house. Right? Now I've seen people owe, $500,000 to I've seen people owe $30,000. Right? It's the best part about this, you can individualize it to them. Let's just say in this instance here, Joe and Mary, they own a house and their house cost $200,000. That's what they got left on the mortgage. $200,000. Well, that's not $200,000. That's $200,000. Right? So $200,000. If something happened to you, Joe, where's Mary going to come up with that $200,000 at? You know, and this goes back to, this is one of the easiest benefits and problems to go over with people, because this is something tangible. That's a house. That's a legacy you're leaving for your family, right? Most people work very hard to make sure their mortgage is paid and that they own property, right? But unfortunately, with mortgages, when you take a mortgage out from the bank, you don't own that house. You don't own that house until it's all paid off. Typically 30 years, sometimes 15, all right? So that bank owns that house for the next 30 years until you pay it off, all right? And to be honest with you, that bank does not care that you passed away. You're still going to get those mortgage payment bills in the mail every single month, whether Joe's here or not, right? So it's actually one of the main reasons why foreclosure was so high, why a lot of people foreclose on homes, because one member of the family passes away and they can't keep up the same lifestyle because they didn't have protection for it, right? So mortgage protection, you kind of just want to get what number they have and just show them, visually show them what they have, right? So Joe, if you did pass away tomorrow and you know that the mortgage is protected, about $200,000, right? You want to make sure that all that's protected so that Mary can just use that money, pay off the house, and you guys can live in the house for the rest of your life. All right. Just the big thing you want to explain with mortgage protection is that you can even ask them this question. I would typically ask them, Mary and Joe. I would say, Mary and Joe, what would you say is the biggest asset that you own? Right? And 99% of the time they answer our house. You might get one or two people here that say, oh, my quad, or my horse is out in the back, right? Or my big TV down in the man cave. Right? The last thing you want to do here, guys, is like kind of crack jokes during this part. You want to be serious during this part. Like, even if I've had people say that to me, I never really laugh at that because I know that what they're trying to do is deflect. They're trying to push off what I'm saying because it hits home. That's what they're doing. They don't want to talk about it because they have these problems, you know? And when they ask that question, just be serious with them. Like, I get that you think your quad is the you know, the biggest asset that you own, but to be honest with you, it's probably your house, right? And he'd be like, yeah, it's probably the house. Now, if they don't own a home, if they're renting, you don't have to ask them that, you know. But to be honest, most people have mortgages. Most people we sit down with have mortgages. If they don't, they live in the city, they have rent. You can still do that too, right? What's your rent every month? $1,000? Okay, 12 grand a year. We know we're probably looking at, if you wanted to make sure you were renting there for 5 years, right? It's probably looking at about 60 grand, right? And you'd put the number. Just do the quick math. It's not too bad. Just whatever number they give you in rent, multiply it by 12, and then multiply that by however many years you want to protect it for. Same thing. You can make sure that the rent's paid in your apartment for the next 5 years. Your family has 5 years to figure it out. Wouldn't you say that's enough time? All right. So what I'm getting at with the mortgage protection as well, making sure that you put the amount on there, making sure that they understand it's the biggest asset that they own, right? But until it's actually paid off from the bank, it's not an asset, it's a liability, right? So typically it's people's biggest liability. So once again, if they have more than enough coverage over here, so let's say this guy had 200,000, spend it over here. Spend it. Whatever life insurance they already have, this is where you're spending it for them, right? So mortgage protection, if they have $200,000 through another company, spend it right there. Cross it out for them. right? Make it unique to them. So you guys have any questions on mortgage protection? Okay, just so you know, typically what it recommends to protect mortgages is either 30-year decreasing term or a 15-year decreasing term, or if they're older, probably recommend accidental. Right? To be honest, most of the time I would recommend accidental to take care of that. All right, because if somebody's young, typically, if someone's under the age of 40, the number one cause of death in America is an accident. So if they die, if I ask you if you're going to die in the next 30 years, how do you think it's going to be? You think it's going to be an accident? Or you think it's going to be because your health's bad?
Accident.
Most people say accident, right? So mortgage protection, we're good there, guys. No questions. Beautiful. Okay. Then the fifth concern for a lot of our members is making sure that the child's education is taken care of, or that they don't have any debt, or to leave a legacy. All right? There's going to be 3 different things here. They're all the same exact need. Making sure that if they didn't come home, that their loved ones didn't have to worry about things like education or debt, or leaving somebody with a burden, if that makes sense. Right? Kids education is the easiest to do this with by far, because most people want to make sure their kids have a better time than they had. They want to better their future. So typically that involves school. Typically that involves college or trade school or something like that, right? I'll ask these people, I'll ask our members, I'll say, Joe and Mary, do you know how much it costs to go to a 4-year university now? And they're like, a lot of money. I'm like, yeah, it is a lot of money. It's anywhere from $50,000 to $100,000 per child, right? Now, if they got 1 or if they got 2 kids, I'll put arrows to 2 kids, right? So at this point, that's $100,000 to $200,000 that they would need, right? So I would say, Joe, if you didn't come home from work, right, and wouldn't you want to leave your kids an opportunity, to go to school or open up a business or go to trade school, right? Let's leave them an opportunity. Let's not leave them a burden. Let's leave them an opportunity. Leave them a legacy. I can't think of a better legacy to leave a kid than either a home or education, right? And this final circle is most of the time, it might not be a concern for a lot of people, to be honest. Most people might not have a lot of debt. And when I ask people about debt, I'm talking like $10,000 to $100,000 in debt. Like 3 to 5, not worry about that. That's nothing. Right? I mean, it's not nothing, it's still debt. But at the end of the day, your family could come up with that or figure that out. What they can't do is if you're in debt for 50 grand, they can't come up with that. It's a lot of money, So, Javon's calling. And in legacy as well. That's leaving a legacy for the kids, like the Head Start program. Right? Getting the kids' whole life insurance locked in for the rest of their lives, locking their age and their health in. Right? Building wealth that they can use down the road. Right? And this also, legacy can also go back to making sure that they have a bigger whole life policy. So it'll build cash value that they can use down the road. Right? So this legacy can be a couple different things. Right? So this is probably one of the easier ones to explain too. You don't have to spend as much time in there. But if they have kids, like this is a big one to kind of go after too. Making sure that their kids' education is taken care of. Right? And I mean, I use personal experiences with stuff like this too. You guys should use like stories sell. Right? I mean, I was raised with 5 brothers. Right? I was in the middle. So my mom did not have any money for us to go to school. She said, if you want to go to college, I'll co-sign loans for you. But guess what? I'm not paying any of them. And I don't have any money for you to go to school. So you're gonna have to get a job or do something, right? Only 2 of us went to school. I'm the only one that graduated, all right? So, and I persevered through a lot in school, a lot. I had a job every summer. I worked all through school. It was not fun. You know, all the money I made went to my school, right? And then when I got out of school, my mom stayed on me to pay my student loans back before they were even due. Like she would take my paycheck and put money aside from it and pay my student loans. I'm so thankful that she did that because I would have bought so many dumb things I don't need. My student loans were paid off in 3 years because I got a job in the oil field. I was making good money at the time, right? But a lot of people don't have that gift. They can't do that. They can't leave their kids that money. This would be a way to do that. Make sure their kids can go to school debt free, better themselves, right? So those are the 5 concerns. The 6th one is affordability and being able to qualify for the benefits, right? And that would be the needs analysis, breaking that down, right? And then the medical questions. The main way that they can't qualify is if they're medically uninsurable. Just know that. When people are like, how do I qualify for the benefits? Well, sir or ma'am, you got to make sure that we go over the medical questions with you, because everybody does try to qualify for the benefits, but not everybody can, right? So we're going to go through these medical questions, make sure you're insurable, all right? So with the list of concerns here, you should be breaking it down to their situation. That makes sense, all right? Now, the reason why this is the most important part of the whole closing process and the whole sales process is because, number one, you're making it unique to their situation. And then the second part is you're going to sell them, or you're going to make them sell themselves on why they need it. You're making it real to them. All right. So once I have all of these on here, like one of the most important questions you're going to ask them in a whole presentation is, Joe, God forbid, Joe, you passed away tomorrow and you could take care of just one of these. You could either take care of your final expenses, your income protection, you make sure your mortgage is paid off, or you could send all the kids to school. What would you say is the most important to you if you could only pick one? And just wait for him to respond. So if Joe says, income, I want to protect my income. Well, I'll circle income and then I'll go. I always repeat what he says right back to him. He says, income protection is the most important. You would say income protection, Joe? Joe, you said income protection is the most important, right? He would say, yeah. Joe, why would income protection be the most important to you? Why would you say income protection? And he would say something like, my paycheck is very important to the house. I don't know what Mary would do if my paycheck didn't come home every month. Okay. I'll say, yeah, that's nail on the head there, Joe. But why is your paycheck important to the house? What does your paycheck do for the family? Right? You want to get deeper into it. You don't want to just ask them why. Build on why. He said his paycheck's important. Joe, what does your paycheck help the family do? Pay the bills, right? Make sure that the cable is on so your family can watch football on Sunday nights. Make sure that the internet's working so that the kids can play video games, right? All of that stuff stops if your paycheck stops. So what you want to do is pick out what they said, reaffirm why they picked it, right? Ask them questions right here. You want to go 2 levels deep with the questions, or you want to ask them why, and then whatever they say there, why is that important to you? I understand that it is important, but why is it important? You guys get what I'm saying? All right. Now, let's say Joe and Mary are both here. I'm going to ask the same question to Mary. I'm going to say, Mary, same question to you. Mary, if God forbid you did not come home tomorrow and you could make sure that one of these was protected, what would you say is the most important to you? All right. And she would say, I don't know. I would say the mortgage. Right. So I would circle mortgage. Once again, Mary, why is the mortgage most important to you? Because, this is a home. We've been here for 15 years. I can't see myself going anywhere else. Right. So Mary, it's probably important that you keep everything in the house and that you keep things the same, right? Just for the family's sake. So the house would be very important to you. Why? Why would it be important? Is the house special? I mean, did somebody build it for you? This is the first house we ever built. Something like, what I mean? You'll figure out why it's important to them. To be honest, you can just tell them, like, if they've been in that house for 15 years, it's not a house anymore, it's a home. They made it theirs. It's two different words, guys. I'm sure you've all been in a house before, and I'm sure you've all been in a home before. Right? So that's these, to be honest with you, when you're going over this with people, most of the time they're going to protect mortgage, income, and kids' education. Most of the time. Right? Now, please be smart about when you're describing these, because if the income is already taken care of, if he has this already, I'm going to scratch it off. And I'm going to say which of these three is the most important to you. Right? Or if there's only one, if they're great, they got all this coverage, they got all covered. I would say, so it looks like, Joe, that you really only have one need and one concern, and it's to make sure that the final expenses are protected. Right? So making sure that, Joe, if you didn't come home, no one was placed with that burden of $30,000 on your family. All right. So with this part, that question is very, very big, because you're getting them to sell themselves. The mentality behind it is they're telling you why they need it. Right? And you could even throw in here to people, like, there's no right or wrong answer to this question I'm going to ask you guys. Right? But I'm going to ask you a very serious question. You can lead with that. I would lead with that. Now, Joe and Mary, keep in mind there's no right or wrong answer to the question I'm about to ask you, and it's going to be a very serious question. But if you didn't come home from work tomorrow, Joe, and you knew that one of these was taken care of forever, what would you say is the most important to you? All right. Make sure you ask both of them that. Don't just single some person out. Make sure you ask them both. Okay. Now, keep in mind, you're not always going to have all the options for everybody. You might sit down with a single person who only has final expense protection. No one's relying on his income, he rents, and he doesn't have kids. At that point, you want to make sure that final expenses are protected, and then throw the legacy in there at him too. Making sure you can use that cash value down the road. Right? You'll be able to show bigger policies that way. Select life, double select life policies. Right? So anybody have any questions on a list of concerns, like how to visualize it to them, how to paint the picture? The better you get at doing this, the easier the sale is going to be. Right? Because they're going to see a need for it. We're showing them the need here. All right? Anybody have questions on that?
When does for the Head Start, when do they start building cash value for the kids?
Cash value, I believe, in Head Start starts after 2 years.
They can still build, even though they're like 5 years old. 2 years later, they start building cash value.
Now, keep in mind, with Head Start policies, they're not going to build a lot of cash value because they're only paying $5-6 a month. But it's still, when I show Head Start policies, it's not for cash value. It's not for paid up options, because those are good. What I do with Head Starts is I make sure they understand the guaranteed insurability option. Their health, locking the kids' health in. Right? Because everyone's one bad doctor visit away from being uninsurable, right? So, and what I usually tell them, I say with the GIO, and make sure that their health is locked in from now until they turn 40. They actually have option years to increase the policy. So if heart disease, diabetes, cancer, stroke, anything like that runs in their family like it does mine, and they get it, they can become uninsurable. But because they have this on their policy, they're actually able to increase their policy every option year without answering medical questions. Right? So I don't really sell on the cash value of the paid up options for a younger person. I usually sell, like, especially for somebody who's under 18, I usually show them the insurability option on it. Right? Just because you don't know what health is going to look like. That was a very good question, Edgar. Anybody else got any questions on a list of concerns, how to kind of explain them to them? And there's more fluff and there's more verbiage in your script like the last part of that page of the script, there's so much more fluff you can put in there, and there's so much more fire you can put in this, but this is kind of the basics of it, okay? And the kind of the mentality behind it, why we're explaining it to them. Does that make sense? Now, I want you to keep in mind, guys, that there are certain points in the presentation where you're having fun, you're energetic, you're having a good time with them. This should not be one of them. This should be very serious. Talking in a deeper tone, right?
So how do you avoid if they're like, I'm sorry, not to cut you off here, Drew, but
No.
how do you avoid if they're like cracking jokes? Like, do you just kind of like smile at them? You're like, I understand. How do you say it without being like rude?
I would say, now, Mary and Joe, this is kind of the last thing we're going to go over with you. You know, I do need your full attention here for the next 5 to 10 minutes to go over with you. It's pretty serious. So I'm going to ask you a couple serious questions. You know, all I really request is some serious answers. You know, to be honest with you, Aubrey, if you smile and say some of these things, you can almost smile and say anything to people, to be honest. You can kind of say very rude things. Like, I don't think they're rude. I'm just doing my job. Do you know what I mean?
Right. Yeah, exactly. Gotcha.
But you're going to get some people who you're having a really good time with, and you'll see our members are great. I'm sure you guys have been at sits with members making you laugh and all kind of things, right? If you're doing the presentation right, it will get serious. Do you know what I mean, Aubrey?
Yep. I was just kind of wondering like how you pull someone back because I know a lot of times I've listened to Dalton go through sits and like the wife will be right there with you, but the husband, he's kind of tougher. He's not really paying attention. He's like, well, just bury me in the backyard. I don't care. And you're just like, yeah, Joe, but that's not really, I don't know how to like pull them back, like get him right there with you guys.
Yeah, I mean, that would be a good thing. Like, you do get that a lot. I've had many people be like, hey, you can just bury me in the backyard. I would be like, Joe, I understand. That's probably the easiest way to do it and the cheapest way to do it. But to be honest with you, that's illegal. You can't do that. If it was, don't you think everybody would be doing it? Unfortunately, can't do that. Right? So, you know, if seriously, if something did happen, how much do you think it's going to cost for your funeral, Joe? Right? You can really adjust what they say with the tone of your voice, how you respond to it. Does that make sense? If you lower your tone, it automatically gets serious. You know? But it takes practice to do it. Like the whole presentation should be like an emotional roller coaster for them. Right? We're having good times at the beginning. Oh no, it's getting serious. Oh, we're coming back up to good times again. Right? And at the end, they should be like, wow. That was great. I had a great ride, right? They should thank you at the end for helping them out. That's how you know you did a great job. But the more you do it, Aubrey, and a lot of it goes back to previous parts in the presentation too. If they see you as an expert, they're going to just understand that it's a serious part, right? And now you're gonna run into jokesters, people who don't see a need for it. That's your job to make sure they see a need for it. That's your main job, right? To show them a problem and concern. Like a lot of these people don't know that these are issues or concerns until we show them that they're concerns. Because to be honest, most people don't confront problems. They don't. They just live their life. And if it pops up, it pops up. There's like one thing that you shouldn't do that with, and it's in your life, because that's the only one you got. You know? So if it takes just saying that to them, hey, this is pretty serious. These benefits are set up by your union. This is the last part I have to go over with you. Just stick with me for the next 10 minutes. Okay. I promise I'll get out of your hair soon. You know, just be assertive with them. Like if you're worried about them being mad at you, you're worried about the wrong thing. You know what I mean? Like you should feel that you're like, you don't want to be friends with them. Like you do, there's a fine line, a very fine line between being a friend with a client and them being too friendly. Because with your friends, they probably tell you no all the time, right? Because they're your friends, right? We don't want to hear no from our clients. We want to hear yes. So if you're too friendly with them, you've built too much, rapport that's not with the presentation. If you're talking about things that don't matter, then you're losing them. You got to reel them back in. Reeling them back in is getting more serious and saying, hey, Joe, these are what's set up by your union. Just give me another couple minutes to go over with them and I'll be out of your hair. Cool? Perfect. All right, just kind of acting like you're doing it over. Like, you shouldn't have to act like it because you're going to be doing it over and over and over again. This is the same process I go through with every one of my clients, Joe. Every one of your guys in the SEIU. I do the same thing with everyone, so just let me get through it, okay? And I'd be like, okay. Or, Aubrey, if they have issues, you should ask them questions, if that makes sense. Right? If he's like, oh, man, I could see, that final expenses. Like, I have 15 grand for that. You have 15,000 for your final expenses, right? Where did you set that aside specifically for your final expenses? You didn't. Oh, okay. What'd you set it aside for? And then they'll tell you, oh, I don't know, in case something breaks down at the house. Okay. So in case your body breaks down, you're going to use it for that? Probably not, right? But that was there's no like simple way to do that every single time. It's based on like the relationship you built with them. You know what I mean, Aubrey?
Yeah, no, thanks, man. That clears it up.
Okay. Anybody else got any questions on the list of concerns or kind of how to explain it or anything like that? No? Perfect. Okay, good. So what I want to do now is I want to go into EAP with you guys and kind of show you the videos on how they would correspond here. So what it would break down the recommendations based on that. Does that make sense? Okay. So what we're going to do is I'm going to give you guys like a 5-minute break. I'm going to switch these cameras around real quick and then we'll hop back in. All right. So take 5 minutes, go to the bathroom. We'll hop back in here. Okay.
Sounds good.
Wait for everybody to hop back on the video. Ooh. I don't know if I like that window. That's okay. All right. Wait back for Roy. Aubrey.
Do you know if EAP is having issues with like playing the videos? Because I don't know if it's because I have a MacBook, but my software, it just like doesn't play the videos. They're just like blank.
Possibly because it's a MacBook. Maybe, I don't know. I don't have Mac. I've never really had any issues with EAP. You can email CAS help or EAP help at ailife.com and you can ask them. They might be able to help you out with it.
Okay.
Yeah, I remember Tom telling me when I first started that the e-app will only work with Windows devices. He said that a Mac is not suggested because of the e-app. So I remember him
Correct.
telling me that.
Yeah, she like partitioned her hard drive, so she split her hard drive in half. So
Yeah.
half of it can run Windows and half of it can run Mac. Yeah, I would email them, Aubrey. They should help you out with that. But all right, welcome back, guys. We switched up locations. What we're gonna do now is kind of like review what basically Josh did yesterday for you guys. Oh, what the heck's going on here? Why didn't he share that second screen? Share. Can you guys see the it says AIL plus health service discount, like the what was that called? Needs analysis. Okay. It just didn't show on my screen because I have a TV up here too that everyone here can see. So this is kind of what Josh walked you guys through yesterday or on Monday, right? Remember the top part? That top part is where they're going to send the information for the AIL Plus card. So that information has to be right up top there. So the needs analysis, it is very intuitive. It's very smart. It will recommend things based on what you put in there. And so for this instance, I just made up some fake people, me, Mary, and my little son, Alex. All right, got all their information in. Now the medical questions, right here. If they answer yes to cancer, yes to diabetes, yes to oxygen, yes to heart attacks, yes to terminal illnesses, yes to Alzheimer's, they will be declined. They will not be able to have protection. All right, so it'll automatically not put them on the needs analysis. Tobacco is okay.
Any one of those, right?
Correct. This volume here. Correct. If they have any one of those. And that typically it's like the last 2 to 5 years if they have that stuff. Okay. So tobacco, it's okay. They can have tobacco. Just know the rates are going to be higher if they're tobacco users. Parole, probation, DUIs. If they've had multiple DUIs, it's a little bit of an issue. They just have one. They cannot currently be on parole or probation though. They have to be off that. So that will typically be, a decline there. But the household information from this section down is what the needs analysis is going to use to recommend coverage for. All right. Now, did Josh go over the $5 to $6 question with you guys? Yeah.
Oh yeah.
Yeah.
I'm
Yeah.
not sure. Yeah.
So the $5 to $6 question is now, Mary and Joe, if you set aside $6 out of every $100 that you brought into the family, to protect the family, would that drastically change your lifestyle or take food off your table? Right. The reason why we say that is because this needs analysis is going to break down everything. It's going to break it down to about 5.5%, maybe 6% of what they bring home monthly. It's not going to show them any more than that. Does that make sense? So this comes back to the affordability and the qualifying part of number 6, right? So when you put their information in here, you want to make sure you kind of do it from like least intrusive to most intrusive. I'm not saying a lot of people object to this, but I've had 1 or 2 say, why do you need this information? Well, the reason why we need this information, Joe, I don't need it. You guys need it. So first off, the reason why you need to put this in here is so they can show you a good recommendation of what you need. What the needs analysis does, it takes into account everything you have going on, and it lets you know if it sees gaps in any coverages. If it does see some gaps, it will recommend some things. If it doesn't, it won't. All right. And then based on those recommendations, we'll see what we can help you with today. So in order for it to give you a correct recommendation and a correct analysis for you, you have to put the right information into it. You know, if you explain it to them that way, they're not going to have any rebuttal or any issue with it at all. They won't. Right? Because and most people, to be honest with you, will just go with this. They're not really even going to say anything. If you just assume it, that's like the main thing you want to do is assume this stuff. Assume that it's working. Assume that just the next thing. But what I usually do is I start with what life insurance they already have. So I know, Joe, that you said you had about 20,000 through work, and then Mary, you got about 10,000 through work. And you didn't say you had any life insurance outside of work, correct? No? Okay, great. And then you said you own the house, right? What was the balance is about 200,000 there, Joe? Okay, great. Now, with the interest rate, I think a normal interest rate nowadays like 3.1%, 3.2%, something like that. I haven't looked into buying a house anytime soon, but I usually use 3.5. Right, easy. And then how many years they got left? Pretty easy, figured out. Right, let's say that they have 15 in this situation. This one down here, do you have insurance to pay off your mortgage in case of death? Right? You can ask them that question. Most people do not. Most people have what's called PMI, or private mortgage insurance. This is not the same thing as having mortgage insurance. What PMI is if what PMI does is protect big banks or small banks from big banks. Because when a person goes to take out a $200,000 loan from a bank, do you think that bank has 200 grand on hand to just loan that person? No. Where do you think they get that money from? Bigger banks, right? In order for that bigger bank to loan them that money, they have to sign and put in place that private mortgage insurance. But what that private mortgage insurance does is says that if that person dies, then that small bank doesn't have to pay back that big bank. That's what it says. It doesn't say you don't have to owe any money. Your mortgage is still going to be there. But the reason why that's done is because if you don't put 20% down, then they have to make you get mortgage or private mortgage insurance until you pay the principal off. Right? So if it comes to that point, you can explain that to them, but most of the time it usually doesn't. Most people don't have protection in case of a mortgage. Right? They might have like renter's insurance or something like that. But once again, renter's insurance is not going to pay your rent. It's just going to make sure if something happens in your apartment, it floods, it gets on fire, that you're stuck and be replaced. Right? It doesn't replace you. So for this instance, I'm just going to leave it as no. And then how much they have the kids' college education set up? Let's just say 0 for now. We should always typically be clicking checking there too, guys. Make sure checking is always clicked. Once I have all that in there, I just go back up to the top and I ask them what they bring home monthly. So Joe, what do you bring home monthly after taxes? Right? And he'll say, I get some overtime. Not too concerned about overtime, guys. We want just like base what they make. Right? Because whatever they make overtime is bonus. And they look at it as that too. Right? So we want to just get bare bones base of what they pay or what they get paid every single month. Let's just say for this instance, Joe's making $4 grand a month and then Mary's making $2 grand a month. Right? Now, I want you guys to do a little bit of math. So if you do 4,000 and you add 2,000 to it, that's what, 6,000? Multiply that by 0.06. Multiply that by 6%. Comes out to $360. Keep that number in your head, okay? So once you have everything filled out here, you're going to click submit. Once you click submit, of course, it's going to think for a couple seconds here, right? Chit chat, small talk with them for a little bit here. What do you guys got planned for the weekend? Anything cool coming up? right? Let them know, hey, I've been running a few applications this week. It might take a little bit longer to get through this. Sorry. I met down with a lot of families, right? The next thing that, did Josh explain this to you guys at all right here? The next little thing that popped up, the summary, right? It's like a cheat sheet for you guys. It lets you know what it's going to recommend. So you can see for FE, final expenses, it's going to recommend 30,000. It's going to recommend a GIO on that person too, guaranteed insurability option, right? It's going to recommend $220,000 of income protection, mortgage protection, and kids education. And then it's going to show the recommendations for the spouse too. So that's a cheat for you. They can see that. They don't know what that means. Until we explained it to you guys, you probably had no idea what it meant either. So you can let them see that. It's not like, oh man, I gotta flip through this really quickly. You can just kind of gradually click continue. Just know that that's what's going to recommend. And based on this too, you can figure out what videos are going to play. You know that the final expense video is going to play. The income protection video is going to play. Mortgage and kids education. All those videos are going to play for them. Right? Now, the next thing that happens here, once you click continue, it's going to pop up the mandatory read-off letter. You guys can't see that. It didn't pop it up on your screen, did it?
No.
Is it there now? Oh, no. It won't let me pull it up there. But you guys have seen it before, correct?
Yes.
Okay. But you got to read that letter off to them. You have to read that off to them, right? Once you read that off to them, what I do is I stop screen sharing. After I get done reading that, I stop screen sharing. I get back into face-to-face mode, and I hit them with the so basically. So basically, Mary and Joe, the way this works is if I'm going through these benefits, write that whole paragraph. So number one, you're telling them in this letter that they cannot think about, they got to do it today. And then you're reaffirming it to them that they need to do it today. Right? And make sure once you get through that, so basically you say, are we on the same page with this, Mary and Joe? Does that make sense why they have it this way, Mary and Joe?
Okay, Drew. So you would read the mandatory read off at this point because it's actually before, in my presentation, it's before this part.
Now, okay, I'm glad you brought that up there, Roy. I'm glad you brought that up. So with the EAP, it's different if you're a senior or you're under 60. It looks different. So when you do examples, guys, do examples of both. The EAP over 60 years old, it's more simplified. It's easier. There's less things in there. And it also puts the mandatory read-off letter before the needs analysis. That's one of the main differences. If it's a senior presentation, it'll be before the needs analysis. If it's a non-senior, it would be after the needs analysis. Just know in your head that it's going to be there one way or the other. But I would still read it off when it popped up. Does that make sense? If it pops up before when you're with a senior, read it off to them before. Because you're still going to go through the same benefits. All right, that makes sense, Roy?
Yeah, that makes sense.
Okay. Sorry, got agents texting. All right. Now, the next thing that it's going to pop up once you get done with that, so basically, it's going to pop up the needs, what it recommends for them. Now, did Josh go through these with you guys? How to break these down?
Yeah.
A little bit?
I
okay.
believe so. Yeah.
Okay. We're gonna go through it again anyway, just because it's good practice. Okay. So the final expense video is the first one that's going to typically pop up. This is probably one of the best videos that's on EAP, to be 100% honest with you. I usually play this video in every one of my sits, right? Because number one, what it does, and when I pull it up, it's going to pop it up on the bottom screen. It's not going to let me bring it up. If for some reason, it won't let me screen share this one.
Oh.
Oh, there we go. Can you guys see it now? Yeah, okay, good. So I'm going to mute it, but I'm just going to kind of talk through it, okay? So when I play this for our members, I do the same thing. I kind of just mute it and I talk through it, only because I've done this so many times. I can almost word for word say what they're going to say on that video, right? What I do with our members is I say, now this is going to show you why it would show you need for final expense protection.
right? So you guys told me you knew how much it goes into a funeral nowadays, right? What pops up on the screen shows them what goes into a funeral, about 15 grand, right? The next screen that's going to pop up is basically what's going to happen in the next 20 years. Today, it might be about 15 grand for a funeral, but just like your milk, your eggs, your bread, and your gas, every 20 years, prices are doubling. So 20 years down the road, we're looking at 30,000 for that same funeral, right? And the next thing that pops up on the screen is a pretty crazy statistic, right? If you qualify, Social Security will give you $255 in a death benefit. You will get people in presentations that will tell you Social Security is going to pay for my funeral. Oh yeah? What kind of funeral are you getting for $255? You're not getting one, right? And that's if you qualify, right? So the reason why that's like that is that's probably what funerals cost in the 40s when they started that program. All right, nowadays, $255 at a funeral, you're lucky to get flowers for that. So if someone tells me that, oh, Social Security is going to pay for it, I show them the screen right here every time, right? But the video keeps going on, and it really explains the main thing that's going to happen if, Joe, you're not here anymore, right? Who would take care of the burdens? Who would take care of the funeral costs? You know, that's why I would say, Joe, if something happened, who is going to be responsible for the cost? Is it? I hope it's not Mary. I hope it's not the kids. I hope it's not your kids' kids. I hope I don't see a GoFundMe page on Facebook for you in a couple weeks, right? Because that's what it's turning into. Facebook and these, you know, websites to where people can crowdfund for funerals. That's like the new life insurance, guys. That's terrible. You're asking other random people to pay for things that you should have done for your family. I guess in my mind, that's super tacky. Now, I understand the need for it. I understand not everybody has coverage or can afford coverage or can qualify for it. And I understand that people die at random situations, right? But at the end of the day, that person probably had an opportunity to plan. They just didn't, right? So the last part of the video just explains what happens when you pass away. So it brings up the freedom of choice certificate. This is why I would play this video, because it will explain the freedom of choice certificate to the member, 100% clear. Just like I explained to you guys earlier. If something happens, Mary, you're going to take this certificate into the funeral home. You're going to negotiate the cost of the funeral with the funeral director. Once you negotiate that cost, you're going to put it on the back of that certificate, and you're going to sign it like a blank check. You're going to give that certificate over to the funeral director, and from that point on, everything is taken care of for you. That funeral director typically wants paid today, so he's going to call that phone number. He's going to talk to our claim department. Our claim department is going to send out 2 checks immediately. First check they're going to send out goes directly to the funeral director for everything on the back of that certificate, nothing more. Anything left over gets sent right back to you, Mary, as the beneficiary in a tax-free lump sum payment 3 to 5 days later, help wrap up any other costs, right? Can you see why they set this up for you, Joe and Mary? Can you see why many members like this benefit, right? The main reason why it was developed is to give your family sense and stability at this time, so you're not throwing money at problems to get them to go away. Because to be honest with you, most people, what they do with problems is they figure out a way to throw so much money at it that it's not a problem anymore. This is one of those instances where you should not do that. Because to be honest, guys, the funeral director doesn't need your money. He's living a comfortable life. He has nice suits. He drives a nice car. He has a business that people are literally dying to get into. So he has clientele. Why we designed this is so our members don't get taken advantage of, right? A lot of the time when people go into the funeral home, they're not thinking straight. They just lost their best friend of X amount of years. All they want to do is get this process handled. And at that point, they're willing to do anything they can to make it speed that process up, including throwing extra 10, 20 grand at something. Now, it's fine if you have that money and that's what it's for, but 99% of people don't, and that's not what it's for. It's meant to go to their family. So this way, the funeral director has what he needs, The rest of it comes back to you, Mary. Can you see why they have it set up that way? Does it make sense why your freedom of choice certificates were set up? Right? Do you have any questions on how your freedom of choice certificate works? You see how I'm giving them the benefit already, even though they haven't even signed anything up yet? Do you understand how your freedom of choice certificate would work, Mary? Giving them ownership of it, right? Now, once that video is done playing, it's going to pop up a recommendation form, right? And I want you guys to use the expert simulator. So what the needs analysis recommends for you, Joe, or you, Drew, it recommends $30,000 of whole life insurance in force, right? Right now you have an existing coverage of 0. So it does show that need of 30,000, and then it recommends covering that amount. That way, Drew, your final expenses wouldn't be a burden to anybody down the road. Does it make sense why I recommended that amount for you? Right, those little tie downs right there at the end, you're getting small yeses, very small yeses throughout the whole presentation. These are you're gonna nail a bunch of yeses right here, right? And then I always make sure Mary gets the same question. Mary gets the same explanation. Sorry, Mary, same thing with you. It recommends $30,000 to have your final expenses protected. Right now you have an existing coverage of 0. So it does show that need of 30,000, and then it recommends covering that. That way your final expenses wouldn't be a burden to anybody down the road. Does it make sense why I recommended that amount of coverage for you, Mary? Yes? Perfect. Once you get 2 yeses out of them, like verbal yeses, you want to get verbal yeses. If they're shaking their head, not good enough. What was that, Joe? Yeah, yes? Okay, great. I want to make sure we're on the same page. All right? So we'll hit continue, and then the next need is going to pop up. And we know from the cheat sheet, the next need is income protection. Right? Now, there's no coincidence that the pie chart and these are the same. Remember how I told you you're going to explain the pie chart and then you're going to break these down too? You look like a genius if the numbers look the same. They're always typically going to be right around the same too, right? So income protection, you can once again just go through it with them real quick, making sure, Joe, if you didn't come home tomorrow, you knew that your paycheck did. That's what this video goes on to explain.
Your paycheck.
See, first thing it said, your paycheck. Let's see if I can bring this up here again. I want to let me bring it. How did I do it before? There we go. Okay. So this video is great too. I like this video a lot because this is the analogy that I just used with you guys earlier with the heartbeat. Right, Joe, you're the heartbeat of the house right now. Car payments, medical bills, expenses, groceries, gas, right? Every single month, you're going to have these ups and downs, right? But what's going to happen if you're not here anymore? When your heart stops, right? Like if I'm in the home with somebody, when I'm explaining this, I smack the table right at that point. Like I scare them sometimes when I smack the table, but I want them to pay attention, right? Sometimes it takes that, right? So this video does a great job of explaining it. You really don't have to put any extra words into it. It does a great job. And it's only like 1 minute and 30 seconds. Like all these videos, they're only like 1 minute to 2 minutes long. They're not very long videos. And to be honest with you, people are watching TV all day and they watch commercials that last 2 minutes. Come on. This is a commercial that's going to make sure your family can still live without you. Right? So once you click continue there, you're just going to recap the benefits again. Drew recommends 5 years of your income being protected. Right? That's why it says 5 years. Now, 5 years of your income comes out to $240,000. The way they recommend covering that is with a 10-year term. Now, our terms, guys, are 10 years, or RNC stands for renewable and convertible. So what that means is within those 10 years, they can convert that into whole life insurance and it will stay level for them. And it also means it's automatically renewed at the end of those 10 years. So they don't have to answer medical questions to get it renewed. They don't have to fill out paperwork to get it renewed. It automatically just renews, right? So the 10-year term, it's a little bit different than most 10-year normal terms because they can convert it. It's big. I don't mind selling 10-year terms because sometimes it's good for the client. If they can't make a decision, you can get them a lot of coverage for a little bit of cheap and they can make a decision 5 years from now. You know? So, but what it recommends here for you, Drew, you have an existing coverage of $20,000 through work, right? So it does only show that need of $220,000 and then it recommends covering that. That way, at least 5 years of your income would still come into the house, even if you didn't come home. Does it make sense why I recommended that amount? Yes? Beautiful. Same with Mary. Mary, 5 years of your income comes out to about $120,000. They recommend covering it the same way with that 10-year renewable and convertible term. Your job also gives you about $10,000 in coverage, which is great. So you do only have a gap of about $110,000, right? That way, you know, all 5 years of your income will be protected for Drew. Does it make sense why I recommended that amount, right? Like this might be a little monotonous here, guys, but you still want to do it every time. You still want to recap the benefits with them because you just think about this. We're probably 45 minutes into the presentation. We've gone through a lot of information with them. We've done it at least once or twice. Right now, we're like hammering it home so that they understand it more. Does that make sense? Like we're using this almost the same analogies, just explain them a little bit differently so that they understand, like we talked about it one time. Now this is for real, right? This is like hammering it home. So it might be a little redundant. It might be a little monotonous, but just know that you're doing it for a reason. You're re-explaining what it recommends and actual numbers, right? So next thing is going to pop up is mortgage protection. Making sure, Joe, that you had the mortgage paid off if you didn't come home from work tomorrow. All right, pretty important asset.
Everyone drink.
All right, I'm not going to play the video for you. You guys can watch the videos, right? Now with the mortgage protection, you're typically going to see either 15-year mortgage right here. It'll say 15-year or it'll say 30-year. Or it might say accidental, ADB. But how you read this, it says primary right here. So the primary insured is Drew. This would be a 10-year or 15-year decreasing term on Drew for $200,000. Making sure that if Drew didn't come home tomorrow, that the whole mortgage is paid off. Right now, you have an existing coverage of 0 for that. It does show that need of $200,000, and then it recommends covering that. That way, the mortgage payments wouldn't be a burden to anybody down the road, and you guys could actually own the house and not have to worry about paying for it. Make sense? Yes? Beautiful. And then once you click continue, the ADB benefits, like the children's education, it'll sometimes say, would you like to display ADB benefits? Always click yes. Always just click yes to that one. And it will pop up the kids' education. Okay. Once again,
As parents,
not going to worry about playing the video. You guys can watch the video, right? But it's going to recommend coverage here on the primary to make sure that Alex's education is taken care of. Does that make sense? So the primary insured, which is Drew, is going to have $100,000 of accidental coverage on him to make sure Alex's education is protected. Right now, he has an existing coverage of 0. It does show a need of $100,000, and then it recommends covering that amount. That way, if you didn't come home, at least Alex had an education fund set up for him. It makes sense why I would recommend that amount of coverage for you guys. Yes, beautiful. Once you get through all those, you'll see at the bottom it'll say continue. Click continue. Next benefit, next benefit, next benefit. So you're going to keep clicking next benefit until it says continue, and you hit continue. This is what it recommends for them, right? It recommends everything that we just went over. And you can see at the bottom, it popped the cost up, right? $275. Do you remember the number I told you guys earlier? What was it, 360? 360, right? If I click on this right here, see how it says view monthly recommended premium? Recommended premium is 330, 5.5% of what they bring home. So 5.5% what they bring home is $330, but it only used 269, right? So it's less than 5% of what they bring home. And to be honest with you, most people's cell phone and cable bills come right out to about that, especially if you got more than one person on your bills. So now within this part here, you can play around with these numbers, guys. I don't know if you know that. When I close people down, I just straight laptop close them here. My closing process for this is it's the easiest way to do this, right? And you're probably going to get like 1 out of 7, 1 out of 6 people say yes right from this, right? And the more effective you are doing it, that higher that number goes up, right? But what I do is just recap it. So Joe, making sure your final expenses are protected, to have the income protected both for you and Mary, and then to have the mortgage assured and your kids' education protected. it's going to come out to about $275 a month, or we're probably looking at close to about, $180 for you, Joe, and then probably about $110 for you, Mary. Now, is that comfortable for you guys right there? Or we could always adjust it a little bit. And I just shut up and wait till they say something. At that point, I just ask them a simple question. Is that comfortable? If they tell me, yeah, that's comfortable, okay, great. As much as you guys need these benefits, as much as I'd like to help you guys out and get them, we got to make sure you can qualify for them. And I just roll right into the questions, right? They always said that that's comfortable. I'm rolling right into it. Now, if they don't say it's comfortable, or they get a goofy look on their face like, ugh, I don't know about that. 275, yikes, right? You might get some people like that, right? But at the end of the day, like, that's everything. That's the whole protection. That's everything that they need. You can take things off of here, guys. You see, if I just like click take off Mary here, I can hit recalculate and it'll drop it down without Mary's coverage on there, without her whole life. If I want to drop it from 30,000 to 20,000, I hit recalculate. Now it's 244. I can take off Mary's income protection. And these drop down menus too, like you'll see, instead of a 15-year mortgage, I can get a 10-year term and cover it with that instead. But you can play around with these numbers here and get it to where they're comfortable. Or what I recommend is get good at using the e-app, get good at using the super combo so you can come up with A, B, and C options for them, right? Most people are comfortable with A, B, and C. The only way you're going to get comfortable doing it, though, is you going into the super combo. And what I mean by that is if you click submit, it'll pop the super combo up for you. Give it a second here. And what I mean by playing around with the numbers is you could do it right here, right? You can show them option A, 200,000 a whole life, or negative 200,000. How about that? I didn't even know you could put a negative in there. So I would show them option A right here. Option A for you, Drew, $200,000 of whole life insurance with 200,000 of accidental, going to be about $200 a month. That's crazy. It came out to that. 200, 200, 200, right down the line. There you go. Right. Option B for you, Drew, make sure that everything was still protected. Oh, shit. I would go 100, 100, 100, right? $100 a month. Actually, I'd probably still, to be honest with, if this person had these many needs, I would still keep this at 200 because that's income protection and mortgage protection if something were to happen to them, right? $109. And then option C, 50,000 a whole life, still 200,000 accidental, right? $74 a month. That's company average 800 ALP, right? Typically, when you're sharing members, option C, it should be about 800 ALP. That should like be in your mind the least that I walk out of the house with. Now, a lot of the time, some people can't afford that. Some people are in situations where they're working crazy hours. They can't come up with $75 a month. Right? Your job is to make sure their priorities are switched around to where that $75 is nothing. Or fit a plan into their budget. They're like, Drew, I'd love to make sure we got option A, but right now I can't afford option A. I'd like to get up to that point, but how about we start about $60 a month? Then you work with that. You guys can, that you can put the premium in there too, and it'll come up with an amount for how much it costs. So if I put $60 in here, it'll give them 52,000 whole life. Right? So if they want to spend a certain budget, there you go. There's $60 a month. Right? So the only way to get good at giving A, B, and C options is to practice. That's the only way to get good at it. And when I was in training, I was in my 3rd week of training, and this is basically all I did every single morning while Josh was doing different things. He would give me three examples of families, and I would give A, B, and C options to him and pitch them, right? A, B, and C, this is what this does, this is what this does, this is what this does. Which of these options is the most comfortable for you, right? Get them to agree to an option, then work the needs analysis, right? Or then go through the super combo, right? So the super combo is basically another whole training that you can do. I'm not going to kind of run through it with you, but I want you to look at one thing on here on the e-app itself, okay? The one thing I want you to do is you can go to tools, well, sorry, not tools, you can go to help, and you can go to underwriting field manual, okay? When you click the underwriting field manual, it's going to pop up like a PDF. And the PDF is going to look like this. Each one of these is clickable. Now, what this is this is the underwriting, the field underwriting manual for you guys. So if you're in a situation where you're like, oh my God, I don't know, I've never heard of this before. This person has, I don't know, let's see. Let's find one here. Let's just see epilepsy, right? This person has epilepsy. So I click on epilepsy, and guess what it does? It brings me to a sheet that tells me, number one, what epilepsy is at the top. If I've never heard of it before, if I don't know anything about it, I can see a little bit about it at the top. It gives you a description, right? Then the next part down, what you're really concerned about as an agent is this, the life section, the first column. That's what you're concerned about, okay? The first part says information needed or requirements. This is what you need to do in the home as a field underwriter, right? So you should always fill out a seizure questionnaire and an APS form, right? Information needed from the applicant is diagnosis, type and amount of medication, and how many seizures per year. Make sure you have that information, right? Other factors. Cases requiring high ratings apply to juveniles, frequent seizures, or short time since the original diagnosis. So it's going to let you know what goes into the underwriting process, what the company's thinking about when they're looking at this, okay? And then the underwriting action, what the company's typically going to do. Best cases may be issued as standard. Those requiring a rating will range from T2 to T4, and the waiting period is 6 months from diagnosis before application is considered. So if this person was just diagnosed with, petit mal seizures a month ago, they can't get coverage until 6 months down the road. Does that make sense? Each one of these is different. Each one of them has their own diagnosis and medication for it. The one thing that's going to help you probably the most is the underwriting flash sheet and the height weight chart. Okay. I want to explain this to you guys because this is something we've been getting emails and we don't want to move forward with you until you understand this. This T chart right here is the height weight requirements from our company for our members, right? Now you see where it says T4 right here? Anything more than T4 or more is an automatic trial application. Okay. Anything from T3 less is okay to send a standard. T4 on is trial, T3 less is standard. Okay. Why this comes into play here is because as an agent, you're allowed to work with 1 inch or 10 pounds. Okay. Not both, one or the other, right? So what that means is if we have someone here who's 5'10", and let's say this 5'10" person, they weigh 290, right? If we make them 5'11", guess where 290 is now? T3. See what I'm saying? Be smart with this, okay? But do not exaggerate the height weight. They will call and verify this. And they will come back with a modification. It will come back with a high modification. And your member will be pissed off. Okay, so just remember, height weight, 1 inch or 10 pounds. Okay. So how do I minimize it from there? There we go. Okay. So the next sheet down to is the underwriting flash sheet. This is a quick quick glance guide for you guys to know what's an automatic decline right off the bat. Anything in the category where it says L over here is an automatic decline. So most of these things on here are automatic declines. A few that aren't is insulin diabetes, right? There's a couple on here down here as well for like asthma and emphysema. And then there's another one down here for rheumatoid arthritis. They can still get life insurance. But everything else on there, make sure you like read it though. Because like if you see autism at less than 9, if they're 10, they're okay, right? If they're 9, no. Right? Same with there's a couple other things on here. Asthma, less than 3 years, more than 4. Same with ADHD, less than 9, right? So this is something I would maybe print out and keep in front of you. I'm fortunate enough to have been here for 5 years, so I actually have a yellow sheet that I carry with me. We don't really have it in the office, but we do have this. It's on your e-app. You all have access to it. I would recommend keeping this tab open just on the bottom of your screen so you have it at all times, okay? But, I mean, that's the extent of what I wanted to go through with you guys here today, painting the picture with them, getting them to go through the list of concerns and why those concerns are important. And the most important part in the closing process, getting them to sell themselves and making sure they understand why they're doing this, right? Because at the end of the day, people will buy things that they like, but they'll keep things that they understand. Does that make sense? They might buy it because they like it, it's nice and shiny, but if they don't know how it works, the next time something nice and shiny comes along, they're going to buy that and forget about this. Does that make sense? So making sure that they understand why they're doing it is a big, big part of the presentation, right? Painting the picture for them, because once again, we don't have a tangible product. We have a feeling, we have an emotion. And I don't want this to sound a bad way, but to be honest with you guys, when you're doing this, you kind of want to make sure, like if you have a husband and wife, you want to make sure that you're on the wife's side. Because most of the time, the husband's just going to do what the wife wants to do. Like it might sound bad saying that, but you guys will go through presentations and you'll see this. Like I've had women smack their husband and tell him that they're doing this. He's like, I want to think about it. No, we're not. We're doing it right now. Right? And a lot of the time it's because women make decisions based on emotion and feeling. Men typically make decisions based on facts and numbers. Right? Not saying that's every case, but with a lot of the cases, that's how it works. So when we're appealing to the painting the picture, we're really trying to kill Joe off so Mary understands this better. Does that make sense? Right? So hopefully you guys learned a good bit today. Thank you for joining me. Thank you for hanging out with me. We got about 10 minutes for questions. Do you guys have any questions for me at all going through like the needs analysis or explaining the benefits or anything like that?
For the last sheet that you showed us, it had other letters on the side. What does that mean? Because you know how it had an L and those are automatically decline.
Oh, so the other ones on that screen. Okay, I gotcha. So he was talking about the where is it at? Where do I have that? The field underwriting manual. So he was talking about the A, H, and D.
Yeah.
So A stands for accident, H stands for health, and D stands for disability.
Oh.
So you don't have to really worry about those. We're not too worried about accident policies or health policies or disability policies. Typically, we're worried about whole life and life insurance ones. But that's a very, very good question. Good question. Anybody else got questions? No? Okay, cool. It means I did a good job, I guess, huh?
You did an amazing job.
All right, guys. Well, thank you, like I said, for hanging out with me here today. Hopefully you guys get into some sits here and we can rock some presentations. I want to see you all in the group me later today. If you guys all have my number, if you need me, call me. I'm here for everything. My door's always open at the office too. So thanks guys for hanging out with me and I'll see you guys at group me shortly.
Thanks, Drew.
All right.
We'll see you guys. And I'll send you all the recording too. So we got that.
Perfect.
Yep. See you guys.